Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in studios here today, Ez. Pretty awesome program. I don't know, what do you want to talk about today? Anything on top of your mind that recently we should maybe get into?
Maybe just this general disavowal of fiscal reality in America and economic,
Uncertainty?
Best practices, we'll just say.
Yeah, we got the TikTok CEOs talking to a whole bunch of U.S. government regulators.
Yeah, CEO Chu's taking on the keister right now.
So that's kind of entertaining. And I think we got a few other things that's fun to talk about as well. So should be a good show, and welcome to the show. Thanks for watching. Love doing this. This is probably the most fun thing I get to do every single couple of weeks. We try to do a full-blown podcast. We've been doing several in a row here recently just because of all the fun stuff to talk about.
Yeah, it's been banging like the Hilton out there in economics land. But yeah, we do, we have 2 podcasts a month scheduled for the books. And then, of course, you fill in on Fridays. You go live for about 15 minutes every week, just about to review the market performance when something out of the ordinary, spectacular happens, which last 15 months has been every Friday.
No doubt. And now we're doing weekly blogs. So every Friday you can go to shepherdwm.com. I'm going to give you like a little summary of the week, what happened, why did it happen, what does history have to say about it, what we look forward to next week. And we consistently put all the same sort of content out. Like it's different topics. Some of it's personal finance related, some of it's tax related, some of it's just current event news. And the current event news has been so rapid and changing so fast week by week. That's kind of what our focus has been on right now. But the whole point of the show, for those that are watching for the first time, is the news, like they do a really good job of playing into people's fear and greed, like that hardwire mentality that every person has going back to like caveman days.
Oh yeah, it gets into my dreams.
And it's their job. They're good at it.
Yeah.
Now, the one thing they're bad at, in my view, is they don't provide a lot of historical context to it. They just say, oh, this is bad. What if it gets worse? Or what if these other things happen? Why don't you just take a step back and say, hey, this is what happened in a similar moment in history. And, oh, yeah, it wasn't so bad. The world didn't come to an end. Actually, the market did very well after that. All these things. And obviously, past performance is no guarantee of future results for all the regulators watching the show. However, we have to learn from history. Because history tends to repeat itself. We're just a bunch of human beings that make up the marketplace. So that's why it tends to repeat itself. So that's why we do the show, is to give you what's happening, why, and also, more importantly, what does history have to say about similar events so that you can prepare yourself accordingly.
And you have said this on the show several times, which is that, you can only bet on the world one time, on the end of the world one time.
Exactly.
And if it comes true, who are you going to collect from anyway? Right. So, I guess at some point the world will end.
Okay.
But either way, you're going to lose.
Money's not your problem.
It's not going to be your problem. So maybe, we should try to keep as cooler heads as possible, give as much information as we can, and, utilize historical precedent, even though it's never going to work out exactly the same. That doesn't mean we haven't been through extremely similar circumstances before.
Yeah. And it's important, right? I actually got a phone call yesterday.
From Chairman Powell?
Yeah, oh man, I wish we can get in the same room, let alone in the same phone call.
I'd like to knock back a couple of Cadillac Mars with that guy. Not because I enjoy his company, but just because then the gloves will be off,
Yeah, I gotta like calm myself down before I start talking about that. But yeah, no joke, man. I get a phone call yesterday, and it's right before the 2:00 news comes out that the Federal Reserve decided to increase interest rates by 25 basis points, the 9th interest rate increase going back to 1 year ago. And then I had a client call me, and I won't obviously go into details. However, this individual has income for days, like way more income than he could possibly ever, utilize on a month-to-month basis. Some of it's Social Security, some of it's, annuities, and some other things, right? That's the bulk of the portfolio. 95% of the portfolio is income driven. And it's so solid. Like this guy could wake up from now on, he's retired, not quite required minimum distribution age, definitely solidly in retirement.
Yeah.
No debt, just normal living stuff. I'm going to go out to eat or, watch movies, stuff like that.
Yeah.
Pay my taxes, utilities.
Get a new PlayStation.
Whatever. Grandkids taken care of. Like, there's so much income. This guy was so fearful in retirement that 95% of his allocation went to how can I just guarantee income, right? Which, whatever. Those are, like I said, there's certain tools for certain individuals, and that tool particularly worked. The problem was he went too far. Like, he's got so much income, and now it's like you have to turn some of the income off just because you don't have anything to do with it, right? Other than maybe put some in the stock market. So I got a phone call yesterday. That's the backdrop, right?
Okay.
Again, 95% of the money is money this guy will never have to worry about not being there to pay him every single month. Nothing to do with the stock market at all. And he's like, hey, man, if you think the market's going to turn with whatever news Jerome Powell, and meaning turn in a bad way, like 2008 type of turn, then he's like, get me out. It's like, I know that you have bigger clients, just get me out. And I didn't say anything because it wasn't that moment in time where we needed to have that conversation. I really wanted to let what's happening right now kind of speak for itself. But that's the reason why we do this show, is this guy was so emotional about 5% of his actual liquid assets, right? This is money he has access to in the stock market, right? He's so concerned about this little piece of money, which truthfully could evaporate. This guy wouldn't even know it was gone. He wouldn't feel it, right? Wow. From a lifestyle standpoint. But he was so focused on the fear of the decision of other people and how that might affect the market and thus this part of his portfolio, that he was willing to get completely out, which obviously is what people hear all the time. Going back to the beginning of the market data, you can't time the market. You can't figure out when they jump in, when they get out. It's always a losing proposition.
Yes.
Right? You do 100%. Need to have a game plan to deal with now and how things might look in the next 9, 12, 18 months based on what history has to say about similar events. And that's why I'm going to do quarterly reviews with every single one of my customers in person, ideally at the end of every quarter, this guy being one of them. So now we can have the conversation. I can let the data speak for itself because we are outperforming the market for that guy. He just didn't know it.
Yeah.
All he sees is the headline news.
Yeah.
All the things that capture your attention, the fear part.
Right.
And we know based on behavioral finance, I've talked about this in almost every podcast for like a snippet.
Yeah.
Because I get the same thing over and over and over again. Human beings is what makes up the market. We are human beings. We're hardwired with fear and greed. Behavioral finance already proved this to us, that we feel losses twice as much as we feel good about making money. That's what took over this guy's entire mentality. It affected every other part of his day, I'm sure, right? But I can't wait to have this sit down on a quarterly basis and say, hey, actually, we outperformed the market. We took less risk. And this is the reason why we were able to do the things that we were able to do. And I think we actually are going to have a more of a heart-to-heart conversation about what is your real risk tolerance? Let's actually look at your big picture, because he's created his own economy. That's the best part about guys like this. And it truly is the best way to go into retirement. It's like, hey, I have more income from guaranteed sources that has nothing to do with the market. That way you can wake up every day and know, hey, my lifestyle is not going to change.
Yeah.
Regardless of what happens. He's got a fortress of a retirement. He should feel comfortable. I mean, this guy is so set up from an income standpoint, he should be more aggressive than I am.
Yeah.
You know what I mean?
Oh, yeah.
Because this is money that's going to go to his kids. Right? He's never going to spend this money. So we got to have the bigger picture conversation here and not just so focused on what is Jerome Powell going to say here today and how is that going to affect the stock market.
We were talking about this a little before, we started the show. It's nothing new, but it's insane how just headlines and news affect the market's volatility, even, like for a couple hours, much less like a week or a day.
Yeah. And I can already guarantee you, everybody that's watching the show, in April, I'm going to spend a whole podcast on annuities again, because this is what keeps being brought up in these types of conversations, because what they're hearing from these insurance brokers, and that's another podcast probably, is how the regulations just are completely unfair relative to what an agent does, an insurance agent, versus what a licensed fiduciary, financial advisor, from a regulatory standpoint, we get regulated about 50 times more than an insurance agent would.
Yeah.
So I want to break that down for everybody as well, because you guys need to understand the behind the scenes curtain of this particular product. And it is a tool. It's designed to solve certain problems, but the way that it's presented is saying, hey, Mr. Client, I can guarantee you tired of hearing about all this market stuff about whatever Jerome Powell's going to say, or Janet Yellen, or the White House, or whatever. And it's always selling with fear. That's how they lead it off. Like, hey, you tired about all this stuff? Everybody's going to say yes. Everybody's tired. I'm tired of it.
Yeah.
Okay. But then they're going to say, well, we got this product here that guarantees you 32%. As soon as you put your money in there, we're going to match 32% of that. So you put in $100,000, we're going to give you $32,000. That's not the guarantee. That's actually not the contractual obligation. They're just giving you Disney dollars, is what I call them, because it's kind of made up, because you're not accessing that money for 10 plus years. Right. So yeah, you might have gotten a Disney dollar bonus, but your true only guarantee is your withdrawal rate. Right. And his withdrawal rate is probably like 4%. If you take the exact same annuity product, and I'm going to spend a whole podcast on this, if you strip out that 8 to 10% commission that insurance agent's going to get, right? If you strip that out and you actually have a fee-only annuity, which is what we use here, you go from a guaranteed withdrawal rate of 4% to a guaranteed withdrawal rate of 11%, right? That's what that product is designed to do, is provide a guarantee of a withdrawal rate on your own money, right? How much you're going to pay yourself back.
Yeah.
And it's just by stripping out the commission that an insurance agent would get, provides the actual customer the right tool to solve a problem, which is guaranteed income, but you're just getting more of your own money back. That's what we're going to spend some time on. So that's a side topic there. That's a completely side topic. Now,
that might be a Bloody Mary podcast. We might have to have something to.
Yeah, we're gonna have fun with that one. I'd love to get an insurance agent in the studio with us on the mic, going directly back and forth, because I already know what they're going to say.
What's that?
And, they're probably just going to say like, hey, this is solving a problem of providing guarantees. I'm like, well, what are you guaranteeing? Are you guaranteeing them a bunch of money up front? Because that makes no sense, right?
Yeah.
As you give me $100,000, I'm going to just give you $32,000 just because. Something a little shady about that, right? Something's up with that.
Yeah.
Oh, by the way, you just can't touch this money. We're going to invest it, and we're going to pay you out your own money at 4%. The difference is they know how to go about investing it, because they're an insurance company. They don't have a heartbeat. They're going to be around forever. They're looking at it from a long-term lens. They understand things like modern portfolio theory and asset allocation, all that. And that's how they're able to make the money, right? And not actually give you $32,000. On paper, it might look like that, but that's just money you're going to be paying yourself back on. So we need to have a bigger conversation. I'd love to have an insurance agent here on that one. However, that's not today's point.
Let's move on then.
We're moving on. Moving on to Fed Chairman Jerome Powell's decision yesterday. So the headline news here in Barron's is the Fed's new strategy leaves more questions than answers. I don't know if I necessarily agree with that. So if everybody caught last week's podcast, which was a good one.
Yeah, it was maybe one of your best ones yet.
Yeah, a lot of good feedback on that one. So check it out, shepherdwm.com. Takes you right to all of our shows. He raised 25 basis points. The reason why he raised 25 basis points, this is the 9th hike going back to March of 2022.
Yeah.
So he raised 25 basis points even after, 12 days ago, roughly, we had a couple bank failures, right? Now, 2 weeks before all that, everybody was like, dude, we're going to 6. We're going up to 6, maybe even 6.5. Like, that's what everybody was thinking. The market was selling off hard in February, early part of March, and then we had this banking fiasco. Well, those long and variable lag effects to monetary policy take about a year to 18 months. Well, a year ago, almost to the day, we whack out 2 banks, right? We broke something.
Yeah. Oh, man. Shot in the dark here. Lag effect.
So I'm getting there. I'm going to tie this all in a bow. Tie it in a bow.
That's my hype man levity job.
So 25 basis points increase. Now, the reason why he did it is because the market expected it. I think the statistic was like 83% probability markets expected a 25 basis point increase. He did it because of that. The market gave it to him, so he took it. even though you can look at inflation figures and clearly say that they're falling, he admitted that they're falling. The only thing that he's still dying on the hill of the services inflation ex housing. So 2 of the 3 parts of the major inflation calculations is in fact falling. He admitted that. There's one that's a little bit more sticky, still falling, maybe just not as fast of a clip as they would like. That's about to accelerate though.
Yeah.
With everything that happened here with the banking issues, there's going to be a credit tightening when there's less money in the marketplace. Just simply put, you don't need to be a freaking PhD economist here. Just think about it. There's less money in the marketplace. Well, if there's less money in the marketplace, that means there's less jobs that people are going to have. That's disinflationary. There's less money that businesses are going to be able to borrow. The borrowing cost is up, right? Interest rates are up. It's going to cost them more money. So they're less likely to make a lot of investments into their own infrastructure, human talent, advertising, so on and so forth. And that trickles down to every other part of the economy. And you're going to start to see layoffs. You're already going to have layoffs from the banking issues that we saw anyway. You're already seeing it in the tech sector for the last several months. You know, lots of different tech companies coming out and saying, hey, we're not hiring, we're moving postings, and we're actually going to cut staff. So he raised interest rates because the market gave it to him. Even though if you raise interest rates by 25 basis points, again, there's this long lag effect. It would take at least a year for that 25 basis points to actually show up in economic data, right? Stupid. It was politically motivated, in my view, because why would you possibly think it's a wise idea when you know when the banking industry is going to tighten its credit lending? That's the same thing. I mean, he did admit it. It's the same thing as having an interest rate hike.
Yeah.
Right? He knows that. Let that do the job for you instead of you just going on TV and saying, hey, I'm going to raise 25 basis points basically because the market's given me the opportunity to do so.
Yeah.
When you could have easily said, hey, our monetary policy tools are having an effect. You can see it in the latest inflation data, CPI and PPI that we got. Labor market is still tight, but historically low unemployment is actually part of our mandate. So it's good that we have the type of strong job market that we do. But since we don't know exactly the effect of all those interest rate hikes are going to have on the market, because remember, we were banging out 75 basis point increases all summer long.
Yeah.
That's getting ready to start to hit the data. So he could have easily said all that. Our tools are working. Inflation's coming down. You can see the numbers. Services X housing is the one part that we're not fully getting the rapid discount in inflation that we'd like to see. We're not seeing as much disinflation there, but there is some, and we think it will fall. And we don't really know what the lag effect is going to be impact-wise, and we can already see stress in the banks. The banks are going to tighten credit, and we know that that's going to have the same sort of effect as us increasing rates. That's all you would have had to say.
Mm-hmm.
And you could have said, hey, we don't know what the data is going to come out to be here for March. We'll take a look at it, and if necessary, we'll step back in with our monetary policy tools, and we'll adjust inflation expectations if we need to, and we'll potentially need to increase interest rates. But we don't want to cause any more additional stress to the financial system, which is the backbone of the economy around the world, not just here in the United States. Right? What did it say? He didn't take it because the market, again, gave it to him, the opportunity to increase interest rates. Now, the only good part about that decision is if Powell is right, this is all about consumer confidence, right, in the banking system. Are my deposits safe? Because that was the other issue yesterday. You had Powell saying everybody's deposits are safe, and Yellen was saying in a completely different interview that we're not actually considering having a blanket security protection on all depositors, right? So that caused an issue yesterday. I don't know if anybody was watching it like I was, like second by second, but market goes up even after he announces the 25 basis points. It's up on the NASDAQ close to 1.5% or so. And then 30 minutes into the deal, I think that's where they had the crosswire answers to depositors at financial institutions, because I think the reporters knew what Yellen said, and then Powell said something basically completely different.
Yeah.
And the market goes flat, and then the last 20 minutes of the trading day, it really goes negative. Already, though, we're getting all those losses back and then some here today. So here's the only good part. If Powell is right and there is no real contagion issue in the financial industry, which I don't actually believe that there is. I take him at face value on that one. Let's talk about loss of credibility, right, if he's super wrong. But if he's right, and you can increase interest rates by 25 basis points temporarily here like he did yesterday, and there is no systemic risk in the financial services sector, and you continue to get disinflation, then we are truly in a right position here for a substantial amount of gains in the equity markets, because interest rates are coming down, inflation's coming down. The Fed's now more predictable. It's very likely that they won't need to increase interest rates in their next meetings. That's what the market's pricing in right now, is no more interest rate increases and likely seeing interest rate cuts 2 or 3 times later part of 2023. And that is what we've been expecting here at Shepherd Wealth Management all year long. We've really been preparing for this going back to Q4 last year, which is the October lows, and we've really been in a nice bull market ever since then. A lot of people were not positioned correctly. A lot of people were coming into this year, including all the people you see on your favorite CNBC shows and Fox Business News shows or whatever you're watching. Most people were counting on, energy leading, healthcare leading, maybe financials leading, just because interest rates were, they're making more money on their loans versus their deposits, that net interest income. All of those have been basically the worst performing sectors year to date. The best performing sector year to date, technology, far and away, because they're the biggest beneficiary of easing financial conditions. And that's exactly what we're looking forward to. The market is forward looking. Yeah. That's the best economist on the planet, is the market, by the way, right? It's not Professor Jeremy Siegel, who I love, not a knock on him, or anybody that has a PhD in economics. The best economist is always going to be the market, because they're looking so much farther down the road based on what they expect to have happen with the current information. And that's the reason why technology is doing so well. It's 88% correlated with easing financial conditions. So it was no surprise by us. We're heavily overweighted tech, and I'm about to be even more overweight tech based on the information that we got yesterday. So I know that might be a little bit different than a lot of people would anticipate. But if that was the biggest sector last year and still the biggest sector this year, and it was the worst performing sector in 2022, well, it's very unlikely that tech's going to have another year like that. So there's all kinds of things that we can look at to prepare ourselves, but the best one is history. So if we've talked about this, I don't know how many episodes ago, it's definitely been in newsletters I've sent out to clients. So the buzzword right now is artificial intelligence.
Yeah.
That's everything that you hear about on almost every channel. When people start talking about the economy, Chat GPT and all this other stuff. There's been other times in history where we've had labor shortages.
Oh, yeah, for sure.
Right? And tech wasn't not 25% of the market back in the 60s.
No.
Right? Manufacturing.
Or in the 40s.
Right? Yeah, you go to World War II, post that,
yeah.
The best sector was industrials.
Yeah.
Right? No doubt. However, we evolved because, again, if you can't clone people and you can't make people fast enough and get them through an education system and get them to a spot so they can do your task, you have to make investments into automation, either in software or some sort of robot technology that will do that task. And that obviously goes right to the bottom line of the business, because it's a more efficient way to go about operating, right? Mm-hmm. You don't have to pay for health insurance for software. So that's what happened back in the 60s, 70s for sure, parts of the 80s and 90s. It's what's happening here today. If we can't, no CEO or CFO is going to wait on immigration laws to change.
No.
And things of that nature. So they're just going to make investments in the technology. And that will, in fact, cause people to have to find a new career. But it does ultimately, as a society, make things more efficient and better. And we're positioning our clients for that. I think over the next 10, 15 years, you're going to see technology go from about 25% of the market today to probably something closer to 40, 50% of the market over that 10, 15-year period of time. It's going to have its ups and downs, no doubt about it. You start jacking around with interest rates, well, things like tech are going to have a negative year like they did in 2022 in most instances. But when you get easing financial conditions, then the game changes completely. That's exactly the place that you want to be, and we're heavily overweighted tech sector for almost every client. Now, that's the reason, or that's what happened yesterday. Fed chair, didn't surprise anybody with a 25 basis point increase. He didn't need to do it. I think he did it because he had the opportunity to do it and made it look good. From a political standpoint, but it's going to be a cut here in May, June, something like that. And it's going to be the very first, 25 basis points that's coming back to us.
So we might not even feel what he did other than that little blip that we had in the announcement.
100%. You're not even going to feel it. It's not going to show up in the data. We're going to continue to get, so think about it this way. Elizabeth Warren, we talked about that last time. She was just firing away at Powell.
Yeah, did a great job.
I actually agree with her. First time in the history of Elizabeth Warren talking, I'm like, I agree with you on this one.
Yeah.
And you got to think about it. It's so logically right. Like, how could you possibly keep any credibility at all if you're increasing interest rates and financial conditions are tightening because banks don't want to lend any money, and you're continuing to get disinflation on CPI and PPI prints, all this stuff? You look like an idiot.
Yeah.
You look like a complete idiot. So she's right. And because of all of that, that's why I think the markets are basically saying there's no way that we're going to see additional interest rate increases this year, right? And it's just not going to happen with all the things that are happening here.
I mean, do you think if they hadn't been called out like that in front of Congress, we'd still be talking about going to 6?
If the issue with Silicon Valley Bank didn't happen, we'd still be talking about 6.
Wow.
Right? I guarantee it. We'd still be talking about 6 until something else broke.
Yeah.
No doubt about that. So, and then, of course, Credit Suisse got bought up by UBS. There's really only 2 banks over there, by the way, in Swiss. Like, we have 5 or 6 major banks here in the United States.
Yeah.
Right? So if something happened with, Citigroup, you could have Morgan Stanley, JP Morgan, Bank of America, US Bank, a couple of these, very, very large institutions just start swallowing up a bank like that. But I think what happened with Credit Suisse, there's been a terribly managed institution for since they were inception back in 1970.
Yeah.
Awful. And I think UBS was forced to buy them by the Swiss government. But I'd be willing to bet, I'd love to be a fly in the room on that one. I bet the CEO of UBS was like, hey, we'll acquire this crap, but here's how it's going to go down. And I think they basically picked up all of their assets, 30 cents on the dollar, something like that. So they're probably going to whack a bunch of employees. They're probably going to, lean out as an institution, but they picked that Credit Suisse crap up for pennies on the dollar. But it was already a penny stock anyway. So
it's not like sounds like they paid what it was worth.
Yeah,
right.
Exactly.
Yeah.
So the other big one, the big concern that I have as we transition out of the banking topic here for a second, is the regional banks, small, medium-sized, banks. I bank with a small local bank here in Kentucky, and they're awesome. The concern, truly the only real concern that I have as it relates to the financial sector, is 67% of all commercial loans are done by those types of banks, the small, medium-sized, and regional banks. They're obviously JP Morgan and Citigroup, they'll do commercial loans, but when they do one, it's going to be like this massive billion-dollar apartment complex with shopping centers attached with it, stuff like that.
Yeah.
Local stuff is going to be like, okay, I'm going to build a 11-unit apartment complex.
Right.
It's not this massive thing. So 67% of those loans are done by those small, medium-sized institutions. And the reason why that's important is because when we look at Silicon Valley Bank and their failure, well, they failed because they concentrated their deposit base as well as their loan base into really one area, that being tech and specifically small tech startup companies, right? So if all these small, medium-sized banks are concentrating the majority of their loans into commercial, and these commercial loans are due, let's say they come due in a year or two.
Yeah.
Well, I think we all understand that the working conditions in this country have changed. You're not asked to go to a physical location every day, right? You might only have to go there a couple times a week, maybe just a couple times a month.
Mm-hmm.
So as if you owned, a piece of commercial real estate, you were renting it out, you had a 5-year lease or whatever it was, and now only half of your staff needs to be in the office on a regular basis. You're going to look at your tenant or your landlord, I should say, as a tenant and say, I'm not, first of all, I need half the space.
Yeah.
And I'm definitely not paying, the rates that I paid before, and you can kind of go pound sand. If you don't like it, I'll go somewhere else and you can try to do this dance with somebody else. And everybody else is in the same situation. Like, I don't need this much office space anymore because I can have people work remotely, yada, yada.
Right.
And you're going to see charge-offs on a lot of those loans, I believe. So that's my concern, is if we have higher interest rates and you start to have a credit crunch, specifically in the commercial real estate office sector of housing. Obviously, that's disinflationary, and it's going to provide a lot of reasons for the Fed to cut rates, which is going to be good for your tech kind of institutions. But it could cause a little bit more of a systemic problem if we have hundreds of institutions that are forced to potentially sell assets on their loan portfolio, just like SVB had to at a loss, just to provide some liquidity into their own institution. Now, a lot of these federal government programs that the Treasury did might be able to solve for a lot of that. I think we're going to get some data here today and next Thursday about how much borrowing actually came from the Fed's discount window, which has been in existence since the Fed was in existence. That's their primary way for banks to grab cash to shore up their deposits and reserves if necessary before they have to go and sell investments in their portfolio. So
yeah,
I think that's the only major risk at the moment is commercial real estate, and that being a very concentrated thing for small and medium-sized banks, regional banks. But if we don't break anything else and there's no actual issues, I truly don't think there's an issue, because if there was to become an issue, the Fed's already made it, known that they're not going to allow an institution to, or a large, significant institution to fail.
Yeah.
So it's basically implied government-backed insurance on your deposits.
Huh.
Now, the other topic of the day here has to do with a few things. So we got TikTok CEO talking to government officials, and we also have Coinbase tumbling significantly. I don't know if you saw that news, Ez.
I did not.
So Coinbase got a little love note from the SEC.
Let's hear it.
It's called a Wells notice.
Yeah.
And essentially, the SEC will give what's called as a Wells notice to an institution just before they start to file criminal charges.
Oh.
And this has everything to do with the quote unquote stable coin, right? So you know how you can have an account at a place like Coinbase, right? They're essentially a brokerage for crypto, and you can essentially earn interest on lending out coins, right? They don't call that a security, but the SEC wants to call it a security. So that's in a nutshell why they are sending out this Wells notice.
Yeah.
But that caused Coinbase stock to completely just fall off a cliff.
Yeah.
And it had just one of the best runs, one of the best performing stocks so far year to date. It went from like 30 in January to as high as 80, and it was hanging out in the 70 range, and now I think it's, I don't know, less than 50, something like that.
Wow.
So, yeah, it's whole sector's got a big target on its back right now.
It does, where there's a scam. I mean, obviously, a decentralized currency anyone can use, free from regulations, that's going to be like, and no government wants that to happen, right?
Of course. And
the people do. No government does. But, you're seeing it now time and again. The honeymoon phase is over, and the crypto boom is settling down, just like the dot-com bubble happened, right? I mean, you have your major players that are actual currencies that you can spend and do things with that are not going to go anywhere.
Yeah.
But then all this other stuff that was just total, it's just a scam, right?
Yeah.
Those are the ones that are getting hit.
I'm not a crypto investor, not for myself or clients. Obviously follow it.
Yeah.
It's topical news. Obviously people invest in it. So we're going to talk about it.
Yeah. I hold crypto.
Now, the thing is, I was watching, Compound and Friends with Josh Brown.
Oh, yeah.
Big shout out to Josh Brown. Love all of his stuff.
Yeah, we're fans of that podcast here.
Yeah. And he was saying yesterday, he was talking about the same thing on Coinbase. He was like, if you like crypto, if that's something that you want to have as part of your asset allocation, then just go buy that specific crypto directly. Go buy Bitcoin.
That's it. Like Bitcoin. That's exactly it. All this middleman, all this.
You don't need the volatility of a brokerage company for crypto. And in his view, and I would actually argue that makes a lot of sense to me too.
Yeah, my personal trading platform, which I'm not going to say on here because I don't want to influence anybody. I don't get anything from them for using it.
Yeah.
You know, but I picked the one that worked for me, and I just buy it directly on there.
Yeah.
There's no other. That's it.
Yeah. And then, you know, the TikTok thing here is just hilarious. I can't wait to see all the memes that come out from this one.
Oh my gosh.
Because, you know, it's so funny because you got, you know, no offense to all these government officials, but they're older generation.
Yeah.
I bet a lot of them have to get somebody to help them open up a PDF.
Yeah.
And they're trying to figure out how they're going to regulate, you know, things like social platforms, TikTok being one of them. But that's just the tip of the iceberg. Like, how are you going to regulate Chat GPT and all this AI stuff that's coming down the pipe? Like, they might want to get a few younger folks around them that maybe know how to at least open up PDFs and simple things like that. Like, I don't know. This is like a good topic for your commentary here, as I have to say.
Well, in all seriousness, and I know this is going to be very unpopular, and I don't mean this to be offensive. I just have no other ways to articulate this. But there has never been a larger technological divide between generations.
Oh, yeah.
And if that isn't an indicator that a certain age group needs to be in position to make policies and a certain age group needs to quit and go off and do something else. Like, I'm sorry. Like, if you don't understand we saw somebody ask this guy earlier about accessing his own home network. He was asking the CEO of TikTok how the app works.
Right.
If you don't know those things, this grilling of the CEO isn't the place to find out, and you don't need to be in charge of the policy.
You know what? I'm not mad about it, though, in the sense that, you know,
I mean, it's one more log on the fire that we have going right now in our country.
I get that. You know, the whole TikTok thing, I'm like, oh, I'm a Meta shareholder. So this is good for Meta shareholders. It's kind of my first thought. And that's just, you know, first reaction. But I guess the bigger point being is like, to what we're really talking about here is, I don't really give a crap what happens to TikTok or not, but I would prefer that if we're going to, you know, provide more regulation on a sector like this one, probably not the best group of individuals to make decisions on that.
100%. I mean, for those of you that are listening to the podcast and you don't know, this is a maybe oversimplified, but a complete reduction of what's going on. TikTok gathers more of your personal data than any other app you can ever imagine. That is why it's banned from use by government employees and military personnel in the U.S., right?
Yep.
So the fear of it being used to spy when it comes from a country like China, you know, maybe that's not that's where that's at. It's like, it is so invasive into your data. So when you download it onto your phone, you agree to share so much more of your data than you do for things like Meta, Twitter, you know, YouTube, all the others. So that's where all of this is coming from. So it's getting all this red herring in the talk up here about why is there all this misinformation, you know, stuff on TikTok that's not true about health and all these things. Like, that's every social media platform. So to your question, yeah, like there needs to be more regulations on things like that, or figure out how you can mitigate the effects of that kind of, you know, complete misinformation that actually could harm someone going on social media.
Yeah.
But yeah, so I don't understand all these other things that are going on in this dog and pony show we're watching back here.
They had to have a meeting on something, so they just decided to do this one. But yeah, I mean, it's funny. We'll see what happens. It's obviously not, you know, it's not an investment for us here. And it's more of a way to look at things bigger picture wise, because
100%.
It's not about TikTok. I don't care if they get banned. They probably will get banned from this country, but
they very well. I mean, they probably will, honestly, because they're going to need to do something to make it look like they're doing something, and the easiest thing is that.
Sure, so that's fine. Well, let them do what they're going to do in some other part of the world. But the bigger picture of regulation is a little funny, but somewhat scary too, because we're going to have so many more advanced, way more beneficial, can impact the business right away type of technology here with this Chat GPT thing. I'm super excited about. And this all goes back to solving a problem. What is the problem? Is we need people to do specific tasks, and we have some people doing tasks that we don't really need that anymore in this country, right? You get Chat GPT come out, and yeah, you might have a bunch of copywriters that all of a sudden don't have a job, but they'll probably be able to get into an industry that will probably potentially pay them more, provide more opportunities, because it's a task that is now way more valuable in the eyes of that employer.
This is a little pipe dream here. When are we just going to have to work less?
Well, I don't want to personally. I want to work smarter, but
yeah, but smarter doesn't necessarily mean harder.
Yeah,
right. More efficiently. So if you can get 50 hours worth of work done in 20, then what are you going to do with the other 30? Like, why can't? When are we going to get there? That was the promise when I was growing up. Was like, yeah, man, robots are going to do most of our jobs, and we're going to live lives of leisure. It's like, that's sick. Let's do that.
What I'm looking for, and what I think most clients are looking for, is freedom, right? Money is a great servant. It's a terrible master, right?
Yeah.
And if you can just get to a point to where you have the freedom, the time, well, time is money. So you're going to need money to be able to do the things that you're talking about here. But you can have a business, a website, with a very small number of actual physical human beings and be more efficient with your time. That's probably what's going to happen. Now, what you do with that leisure time, for me, it would be, well, let's go figure out a way to work with some other people, maybe a different vertical. Yeah. Right. And let's kick ass on this other project outside of, whatever it was that we were already being successful at. That's how I see it. It frees me up. Now I'm more efficient. And if I want to go do the big vacation, I'll have the flexibility to do that. If I need to be at a, Taekwondo, I'm getting a new belt like my 4-year-old did the other day, which is freaking awesome. These little kids in these Taekwondo outfits, just like kicking and punching stuff. Yeah. I can be there.
That's exactly it. Like that's what leisure time is.
Yeah.
It doesn't mean that you sit around
drinking Mai Tais all day.
And, if that's what you want to do, there's nothing wrong with that. But like leisure time doesn't mean that you're, sweating money and that you're sitting, like you're having it just means that no one can tell me how to spend this time.
Yeah.
And it's my time. It's my freedom.
Yeah.
So if I want to spend that time starting in business, I can do it. If I want to spend that time being a stay-at-home parent, I can do it. If I want to spend that time making music or art or learning how to fix my car,
raising money for some charity,
whatever. Yeah, I can do that. So that's what I know leisure time to be.
Yeah.
And I'm waiting for us to get the push to do that, where it's like at some point we're going to run out of things for people to do, and you're going to have to spend 20 hours a week doing some completely ridiculous minuscule task just because there's some notion that we have to be spending X amount of hours at a job. You know what I'm saying?
Yeah.
And they're going to be like, well, we got nothing else for you. So when are we going to get this push, man, to where let the robots do it?
I think that's
we need to be with each other.
I think it's
more
coming.
time with,
Yeah, I think it's all coming, and I'm excited about it. It's not about, just don't want to give people the wrong impression here. I don't think it's about working, 10 hours and spending the other 60 hours that you might have spent running a business or doing a job, just sitting on the beach doing, adding no value to society in any way, shape, or form. I don't think that's what people look. I think there's a small number of people that are doing nothing right now anyway, and just probably bitching about life. That's not what we're going for here. What I think this technology is going to provide us is just like what we're talking about here. It frees you up because of the efficiencies to either double down on that strength to make it even stronger, better, faster, more efficient, affecting more people around the globe.
Yeah.
Or to free you up to say, okay, we're really doing well here. I see a bigger vision that supports this thing that we're already doing good at, but we can also, help more people, drive more revenue, hire more folks, etc.
Yeah.
That's what I see. And that's really what is going to extremely accelerate the economy. It's like going from, 12 cycle engine to like 24, right? Way more fast. Now, you're going to hit a wall a lot harder too under those circumstances.
If your pilot's a moron.
Yeah, absolutely. The Formula One stuff. Yeah.
Oh, that stuff's crazy to watch. Yeah. I haven't caught the bug on that like other people have, but man. I saw my first race a little while and I was like, oh, no wonder people get so excited about that. Like, hey, I couldn't imagine having the reflexive skills of those drivers. Like, talk about some peak athleticism.
And they got to change every year.
Yeah.
Right? I mean, the only constant is change.
Yeah.
Right? We're going to experience that. A lot of people push back against that. Like, dude, just roll with it.
Mm-hmm.
It's going to happen anyway. Just like jump into it. You get a new piece of technology, it's probably going to be gone anyway, you know, in 4 or 5 years. Not everything is going to be like Apple, Microsoft, and Google and stick around. And I mean, hell, Google and those types of companies could be superseded by somebody else. I don't know if that's going to happen in my lifetime or not, but it could happen. IBM was the biggest tech stock back in 1980. Man. That was 6% of the whole S&P 500.
I don't even know where to go to find an international business machine right now.
This should maybe change the name.
I mean,
but you can't. It's IBM.
That like striated blue logo with the capital. I mean, that is like some nostalgic 80s design for me.
That's what people forget though. Like literally, you go back in the early 80s, you ask that trivia question, nobody's going to get it right.
No.
It was IBM, 6% of the S&P 500. You can't even find it, you know, in the S&P 500 hardly. You got to like scroll through all 500 of them with a micro, you know, little.
Yeah, it's not even in alphabetical order anymore. They just pull it out into like the asterisk stocks.
It's all done by market cap weighting. You're like, oh shit, IBM.
Yeah.
Where'd it go?
Yeah, where you at, brother? Yeah.
So the point is it changes.
Yes.
Right? And it's going to be the fastest part of the economy that changes. It's the reason why we're positioned that way. And you have to look so much farther down the line.
It's so hard to, though, because the idea of like a nascent technology and just nascent fields is, I mean, like you just said, with AI being something that people can now wield, you know, and we're not talking like Skynet. It's not actually, you know, it's just I mean, the tools and technologies to break down anything that was an issue before into a new horizon that we maybe haven't even really thought of. We really are at one of those points in history. So it's exciting, but also like you said, it's like you don't think Apple or Google will go away. But I mean, Meta, I know you're a holder in it. They haven't exactly done great the last year. So who knows?
Yeah, and it takes a lot of intestinal fortitude to hold on to that position, right?
Yeah.
I mean, Meta, their stock lost like 70% of their value in a very short amount of time. It's because they were wanting to shift their focus from what's working today to what we think will be, you know, the next version of the internet in 10 plus years. Now that's great, but when you're a business as large as they are, with half the planet, 3 billion people on the platform, and you decide to basically take all those resources and put it into something that can't produce any money for probably 10 years, that's the reason why the stock took the hit that it did. The thing is, it was still the same profitable business. And all they had to do, which they did, obviously the stock price reflects it, is shift to say, okay, instead of spending $15 billion a year on something that's not going to pay us for 10 years, maybe we'll spend $5 billion or less.
Oh,
right?
I mean, that amount
big
of money
difference.
Still makes me,
big difference. But, you know, when you're making hundreds of billions of dollars a year, it's just a drop in the bucket. It's just what they should be doing, is thinking forward down the line. And where can they fit into that new space, right?
Right.
And that's what took the stock from under $100 to where it is today, which is over $200, which is still $130 from its all-time high in the 300s before all this stuff happened.
Yeah, and I certainly wasn't saying that to criticize holding Meta. Like I mean, obviously, I think it's paying off for everybody, and it's one of the FANGs.
That's right.
Called Mang now,
yeah.
I guess. My point was, though, that, I mean, again, we're on that precipice of just going into new horizons with tech and business. And, you know, I'm not trying to, I know we shy away from politics here. It really bothers me that this is even a political statement, but like climate change is real, right?
Sure.
Healthcare is real. This isn't the last time we're going to see a global pandemic in the next 10 years.
I hope not.
Those things are all going to be solved with technology and science, right?
Yeah.
And my point with that was that, like, it's exciting and terrifying at the same time just to think about where we could go to solve problems that haven't even shown up yet. And no one's going to be immune from making a poor choice and possibly making themselves irrelevant, a la IBM, a la the little hiccup we saw with Meta. That was only my example with it.
Yeah, I agree. And I held on to the position, even though the facts on the ground had changed. You still got to look big picture. Like, what other platform, what other asset, business can you think of that's used by literally half the planet on a monthly basis?
I mean, it's insane.
You just got to sit there and say that. You say that to yourself, you're like, they got something here. Even though they took their eye off the ball and they're looking, I want that in a CEO.
Yeah.
I am responsible for doing that for my clients. I got to look way down the line. If I get buried in the minutia of the headline news today, now I'm letting fear take over all decision-making and thought process, and I can't take a step back and look at the bigger picture of things.
Yeah.
Right? And you hear that a lot from a lot of big executives. Jeff Bezos, he talks a lot about that being, looking at the bigger picture as opposed to when he first started Amazon. He was everything, right? He was everything to everybody. Yeah. Now he got to a point where he's like, okay, I gotta take myself back from the fray here. I know I got all these managers are worrying about their own freaking numbers, so they don't look bad on their annual reviews. So they're hitting me up on all of these things that affect them right here in the moment. I got to take a step back and look at the bigger picture here. So that's what I think is a skill that only takes time to learn. But part of that experience of building that skill is that person, that individual, he or she is going to have to understand that you are in fact hardwired with these default programs called fear and greed. You have to understand that. You want to let all the fearful things get all of your attention. And when things are really, really good, you get too greedy, meaning you're too relaxed. You're not looking for that shoe to drop. You got to play in the middle. And I know it's so cliche. You hear these athletes talk about, one game at a time, one day at a time, all those things. It's the same thing when it comes to building a portfolio and managing that portfolio over different periods of time. It's one day at a time with an eye on what's going down, what's going to happen down the road here.
Yeah.
That's what this is about. It's extremely difficult, especially last year when all you want to do is like take your laptop and throw it out the window.
Yeah. And go find that beach with the Mai Tais and just check out.
Yeah.
You're just like, oh my gosh.
Yeah. But you just keep showing up, man. Keep showing up. Good things will happen. As long as you get the data, right? You have the data. You take a look at what history has to say about it, formulate the game plan based on that. And I think you're going to have a ton of success.
Well, and the down parts, I mean, they're just part of it too, right? Like if you want to be, you want to play this game. I mean, you just got to manage those things. And like you said, not play into the fear.
Buffett is the best example of it. I know I always come back to it, but literally 65 years of performance, doing 2 times better than the overall stock market over that length of time is phenomenal. So how did he do it? Number one, he concentrated the portfolio.
Yeah.
He's got 20 stocks. Well, 80% of his money's in 5 names.
Wow.
Right? The reason why, and he would argue this, you can look this up on YouTube yourself. Google Warren Buffett, and you'll find all kinds of this sort of stuff. But basically what he's getting at is there's not that many excellent businesses out there.
Right. Huh.
There's just not that many of them.
Yeah.
So why would you let's say you got a list of your 10 favorite stocks based on all the fundamental research that you're doing, fundamental technical research. You're like, these are the best 10 stocks.
Yeah.
Well, why would you spend any money and energy on the 11th best idea or your 12th best idea or that 13th best idea, right? Why not just say, okay, these are my 10 favorite. These 5 or 6 in these sectors, I see this coming, or I see all these things coming for artificial intelligence. So chip stocks probably should be in my top 5. Let's go overload, that specific stock. Let's do the same thing for these other 4 or 5 stocks as well, maybe in different sectors.
Yeah.
Right. Or maybe in the same tech sector, but in a different, sub-industry class. Right. So that's what he does. And the reason why he does it that way is because it gives him the opportunity to outperform. Because if everybody else just owns the market, they own, the S&P 500 or they own the whole NASDAQ. Well, some of those companies are going to hit 40, 50% types of returns. Some of them are going to be negative returns. Some of them are only going to be like 4 or 5% returns. And you only get the average return of that index, right? Because you own them all.
Right. And
if Buffett owns NVIDIA, let's say, and you own, the triple Qs, which is the NASDAQ's entire sector, that's great. NVIDIA is certainly one of the companies in there, but NVIDIA might only be like 4% of that whole index.
Yeah.
And if Buffett's got, a third of his portfolio in that, you can clearly see why over time he's going to actually have a much better performance than somebody that just bought the index. Now, the problem with that is you got to be right.
Yeah, you got to call that home run.
You got to be right. You got to be willing to do the homework, the hard thing, to come to the conclusion of, okay, is it a fair price first and foremost? Do we have a good CEO? what's the mode of safety for this business? Are they only making money in one specific area of technology? Or are they making money in all kinds of different areas of technology with different products that they can, use to weather a storm if one sector of their business isn't doing that great, for example? Do they have a total addressable market that's just in the United States, or is it worldwide? What does that supply chain sort of look like? You come to all of these factors, conclusions. You say, yeah, this is one of the 5.
Yeah.
Then your biggest hurdle is going to be yourself and actually clicking the button to take a third of the portfolio in this example
and move it in there.
Move it in there. Buffett's willing to do that.
Yeah.
Buffett's willing to do that. Not very many people are going to be willing to do that. And for certain clients here, we are willing to do that. Those with very long time horizons, they're around our age, right? They're not going to be retired for 20 plus years, stuff like that. They have a job. They're receiving income on a consistent basis to sustain their lifestyle. That's how they're weathering the storm, so they don't need to tap any of their actual investments. So we're beginning to do more and more of those types of things. And that does not exist, by the way, at the largest institutions that I've worked at, and I know that a lot of other people have worked at, friends of mine, and it's not a knock on them. They're trying to operate with less risk of their employees.
Yeah.
Right.
Okay.
They don't want their individual employees saying, okay, let's concentrate the crap out of Mr. Jones' portfolio over here. Well, if you build a portfolio for Mr. Jones and I build one and yours is awesome and mine's not as good, but
kind of negates any of that. Yeah.
Kind of negates, performance for the overall firm, and it might open up the big firm to individual advisor lawsuits, which they don't want. So the big firm just says, hey, individual advisors, this is the product that we've created so that we can invest for people, but we're going to control the whole thing. Right?
Yeah.
And that leads to underperformance. It leads to typically bad service because the advisor doesn't want to call the client consistently because they understand in a rising rate environment, they shouldn't be investing in bonds. But their company that they're working for says we're going to hold bonds anyway.
Yeah.
Right. They don't, that's the main reason why advisors at those types of places just do not want to call their clients specifically when bad stuff's happening, because they know themselves that they shouldn't be invested this way. But they have no way to solve that problem for the client because they work for XYZ large institution.
Yeah. Damn.
And that's a big reason why I ended up here. So as where are we at on time? Do we got any time for questions today, or where are we at here?
Well, we're at an hour.
At an hour.
Yeah.
So we're definitely cranking it out here today. I think we'll leave some questions for the blog that we'll do.
Sound okay.
So we'll cover some of that. But I think we got all the things off the agenda here today that we wanted to talk about. So a lot of fun. Appreciate everybody tuning in. Check out the website, shepherdwm.com. We'll be posting a weekly blog there. All of the monthly newsletters are going to start to show up there. So we have last month's newsletter already up there as well. I'm very excited about some new announcements we'll be making probably within the next week or two. Not just with technology, but also from a human capital resource standpoint. So I'm looking forward to that. So that's kind of check out the next podcast in a few weeks here.
Yes. And
I will be working from sunny Florida all of next week, meeting with clients and prospects.
Who's taking leisure time now?
It's a good thing this internet thing goes all the way down in Florida,
Right.
I got to use somebody else's Wi-Fi though, so got to get my VPN working. But we'll do this again in a couple weeks. Certainly appreciate everybody's time. Appreciate the questions. I won't forget to address those. And again, don't forget to go to shepherdwm.com. You can see all the previous YouTube videos that we've ever done, as well as the Spotify links right on there. And of course, there's a whole bunch of information about my company, myself, and what we're here to do for folks. So hope you guys have a great rest of your Friday and have a great weekend. We'll catch up with you soon. Take care.